What's going on, everybody? You're listening to the Daily Stock Market Brief. My name is Michael Silva, and in today's video, we're going to change it up just a wee bit because there wasn't really too much action in the markets today. And I'm going to be going over an investment strategy. We can put strategy in quotes here. It's really just to get my point across that even beginners can do with pretty much little to no knowledge of technical analysis. Okay, can't wait to get into today's episode. Just to kind of break it down, we'll have timestamps in the description below. I'll have also pinned comment with my website in the market dashboard. If you want to see intraday charts, you can follow me on Twitter. You can look at my website, and you can also follow me on Instagram if you want to follow along with some random shenanigans. I do plan on posting more content out there here in the near future. Let's go ahead and get into today's episode. All right, welcome back. We're going to first discuss the different indices. So we're going to go into S&P 500, Nasdaq 100, Dow Jones, Russell 2000, and the indicators. Let's get into the S&P 500 on the monthly time frame. Why the monthly time frame for today? Well, I just want to show you the context of where we lie. Now, this chart probably looks familiar to some of you. The big picture movie or episode that I did got a lot of views, like over 70,000 views in a short period of time. And I'm bringing this chart up here, not to go back over the inverted yield curve, but really to show where this price action is at. Now, we've shown the megaphone pattern. Look at where the price action is coming into this trend line. Resistance, 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 resistance. And then if you even look back further, before it actually acted as support here and then flushed down to the downside, it acted as support here as well in early 2000 and mid-2002 to 2003. So this trend line, it's being tested right now from a resistance standpoint. Why am I showing you this? Well, I'm showing you it, one, because this is big context. Negative divergence on the RSIs. When we had negative divergence before, we saw the market roll over. The inverted yield curve, like I said, when it starts steepening, sometimes we see those pullbacks move with, and we're starting to see it steepen here. Now it's inverted, so it looks a little bit different than usual, but nonetheless, let's go ahead and move on to the daily time frame. What do I want to point out here? Well, look where we kind of stopped. Well, first off, we almost closed the gap here, okay? Basically darn near closed it, and then we closed right by the 5 EMA. It looks like they might be right above the 5 EMA, so the 5 EMA is at 35.80, and then we have the daily close at 35.81, so pretty much right on it, but the bulls got back control of the 5 EMA. This is the VIX down here, still a bull pennant, still in play, potentially can push to the upside. This is inverted. Why is it inverted? Well, first off, they work in inverse correlation. So when you see the S&P 500 spike to the upside, you can see the S&P 500 itself. Sorry, when you see the VIX spike to the upside, you can see the S&P 500 go to the downside. So if you invert this, then the correlations kind of move hand in hand. So I have the bull pennant here, kind of, I wouldn't even call this a bull pennant right here. But if it starts breaking to the upside, that can mean that we have some more room to go up. If it starts breaking down to the downside, well, we might go fill some gaps down below us. Here's the 15-minute time frame. I pointed this out the other day. We broke down, and I said right here, well, what did I say in my conclusion yesterday? I said the areas that you want to look for to buy into are at gap fills or major areas of support. Well, hello, this is the very first one. Major area of support, that trend line, and then a gap fill. What do you know? Well, we bounced from that area. Why is this chart different from yesterday? The only thing that I want to point out here and on the following charts is the head and shoulders type pattern that could be at play. Now it still has, time to form. So this is an early, I wouldn't call it a prediction, but a possibility. And you want to be prepared for the possibility that this is the head and shoulders. Hey, we were prepared for the inverse head and shoulders right here, right? And then it broke to the upside. Hello. You know what's even crazy, actually? If I look at this shoulder right here, that's a left, a head, and a right shoulder. And then you have their sharing shoulders. Oh, no. This is the double-headed dragon. Oh, my gosh. How did I not recognize that? On to the next. Nasdaq 100. Hear the sarcasm in my voice there, by the way. This is the weekly time frame. I just wanted to point out bulls are in control of the Nasdaq on the weekly time frame, still sitting right around this upper trend line of the symmetrical triangle. They failed to break out once. Maybe they'll go for it again. I mean, it does seem like, tech is trying to catch another bid. We'll see. We will see. Here it is on the daily time frame. You can see that the bulls are right, like I said, above the 5 EMA, and we're kind of pinned right there at some resistance overhead. So what can we expect here going forward? Well, on the weekly time frame, I want to just point out, if we close below this on a weekly time frame, 11,500, I think we have the potentially to go lower, but we really need to break through this bottom trend line there. And as you can see, that's the bottom trend line, and 11,500 is right here at the top of this gap window on the daily time frame. So I would expect to see, just a bunch of chop here probably in the near future. I don't see, a huge rise, and I don't see right now at this particular point a huge fall. I just see, the bulls trying to hold this market up and continue to push higher. It's a very confusing time for the markets right now. Let's look at the Dow Jones. Dow Jones, vertical movement to the upside. Bulls, did they recapture the 5? Oh man, I didn't leave the legends up right here. Okay, well, basically closed right on the 5 EMA. They want to recapture that. They don't want to give that to the bears. Heck no. They want to make all-time highs. They want to reach 30,000, that big psychological number, then break out even further than that and just head up to the moon. Why not? Why even take a breath? It's not even necessary, right? But we have all these gaps to the upside, okay? This is just some crazy vertical movement, and now what we're seeing is the market consolidate-ish, if you want to call it that, but it's very, very choppy. When things are very choppy, that means there's a lot of indecision out there. That means that probably not the best time to go long, and probably not the best time to go short. Now, when things get overextended in either direction, that can change our minds. And, I've already said once that I'm pretty much out of the markets as of right now, just because I need things to start trending or some momentum to take place. Negative divergence on the RSI, keep that in mind. 15-minute time frame, what do you know? We had the inverse head and shoulders down here, or island reversal pattern, whatever you want to call it. Shot up to the upside. We're creating another potential for a head and shoulders pattern. Like I said, this hasn't been confirmed by any means. It only gets confirmed actually once it actually takes place. But I can kind of see it forming. The psychology is there in the price action. You had the left shoulder, then you had the move higher. And now what if we start struggling to get above that high? Then investors are going to seek for, where's the stop loss is going to be in. And that's going to be around the neckline. If we start breaking through the neckline, then, sells are going to start getting triggered. It's just what happens. Russell 2000. I'm going to only show the 30-minute time frame on the Russell 2000. Inverse head and shoulders, right? We called this out when it was taking place on all the indices. Now we're calling it out for our head and shoulders. Early, mind you, like I said, but rising wedge, inside the pattern, head and shoulders, negative divergence, both in the RSI and the MACD. All right. Does this have room to go higher? Potentially even reach a new all-time market high? Maybe, potentially. But keep in mind the context of the pattern and the divergences. Things are getting pretty heated. So, yeah, let's talk about just a couple indicators really quick. And then, like I said, we'll get into the easy investment strategy, which is really based around risk focus. All right. This is the CPC, smooth over a 10-period moving average. This has not updated for the 19th yet. Okay. But I can probably share with you what's going to happen. It's probably going to move down. But this is a good sell signal / warning signal. And what do I mean by that? Well, first off, you don't need to exactly know what this put to call ratio is, but really it's just a sentiment indicator. What's the sentiment of the market? Well, we're smoothing over a 10-period moving average because this could be a very quick moving thing. When it crosses below the red line, that is, hey, it's a warning sign. The warning is, hey, the sell signal could get triggered here soon. And if it does, be prepared to take some profits off the table and or make sure you have your stop losses in place because the market can fall. When it crosses above the red line, there is the quote unquote sell signal. That does not mean go short the market in its entirety. Like I already said, it's a possibility to do that. Okay. If it's part of your arsenal, do that. But, take it with a grain of salt. Don't put all your weight into one indicator. I always say that. Now, when it crosses above, like I said, that's a sell signal. Take some profits. Make sure your stop losses are in place. If you have a cool options, advanced strategy, you can start considering it. When it crossed above, we went down, right? When it crossed above right here, we went down. When it crossed above right here, we went down. Doesn't look like much, but we did. When we crossed below and above really quickly, we went down. When we crossed above right here, we went down to sideways, okay? It's been actually very accurate for us, and I'm going to be keeping a close eye on this because we still have some room to kind of run, but it does seem to me that it's going to be crossing here and warning us soon. And if it does that, I mean, that just kind of makes sense because everything that I see from a charting perspective is running into resistance right now and it's overextended for the most part. That doesn't mean that it doesn't have the room to run. I still, some indicators that I use, they still have room to run. It's unbelievable to me. But it is what it is. This is the S&P 500, but we're looking at these two indicators down here. 200 period moving average, 50 period moving average. What does these mean? Well, it means the number here on the side means the percent of stocks in the index that are above the 200 period moving average, and then the percent of stocks that are above the 50 period moving average. Now, when they both cross these high extremes, we've seen markets pull back. Okay, right here, you can see, boom, we pulled back, boom, we pulled back, boom, we pulled back, boom, we pulled back, and now we're right here. 87.58% of stocks are above the 200 period moving average. Like, what? It means that there's some overextension taking place here, all right? Safe to say there's a lot of things overextended. Then we have 81%, but not just to mention the number itself, is the velocity or like just the speed of the move to the upside was absolutely incredible from the 50 period and also the 200 from down here to way up here. Very quick move, all right? Let's talk about the conclusion really quick. First off, to wrap my head around the thoughts of the current state of the week, it's OPEX week. We're seeing a lot of chop in the markets. I'm standing on the sidelines. Why? Because there's no really clear direction. I actually was going to be taking that symmetrical triangle trade on the 15-minute time frame. I didn't get into it because I just said, you know what? I already committed to just waiting this one out, and that was a hard move for me, but, you know, especially with hindsight, obviously, with it going up. But like I said, I'm going to be waiting for the week to end. Maybe we'll get some more clarity, and then I'll go from there, all right? Now I want to start talking about this quote-unquote easy investment strategy that has a focus on risk, okay? Now I'm bringing back up this S&P 500 chart, okay? Long-term chart. We're looking at 95 to 2020 to where we stand now, okay? And what do I want to show you with this? Well, first off, what I've been seeing in the comment sections, not just my videos, but other videos, and you know, people butting heads when the market's gonna collapse and trying to figure out dates and predict this and predict that. I want to show you literally probably the easiest thing I've ever seen as far as just not a buy and hold strategy, but I'm going to compare it to a buy and hold strategy, but a risk-focused strategy. All right, so yes, you're familiar with this chart. I already showed you. Now I show this little line that's moving around. What is that little line? That right there is called the chandelier exit. Okay, I'm not going to explain exactly what it is. You can Google it, but this is how simple this strategy can very well be. So first off, from a buy and hold perspective, if we're just going back to how far I can go back right here, by the way, don't take my math for science and word or whatever. I did a very, very quick math on this, and I didn't go back super, super far, all right? So this is just not to say that this was the best strategy. This is just to give you an idea as to why and how it could be so important to you to focus on risk, not just the upside move, all right? So pretend we're starting with a portfolio of $5,000 on a buy and hold strategy. Okay, in 1995, I like I said, I did quick math. I think we started off at, let me bring that up, buy and hold strategy, $487. Okay, we started with $5,000 at $487, so we bought that many shares of the SPX, just say. And now we're at 3,581. Congratulations. From 1995 all the way till today, we made 635%. That is turning $5,000 times, 6 times, it's 30, add your original balance. We're at $36,750. All right. Congratulations. That is the buy and hold strategy. What is a risk-focused strategy? The risk-focused strategy here is just looking at the chandelier exits, and it's getting out when the month closes below it and getting back in when the month closes above it. So as you can see from here, we rode it all the way up. We got out right here, but then we got right back in. We got out here, then we got right back in. We got out here. We missed that drop, got right in. Boom, 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 boom. Got out. And I think I kept that as a stay because it was too close. Got out right here, and then we got back in, and now we're still in. Okay? Very simple. Like, it doesn't get much simpler than this. This is the S&P 500 on the monthly time frame. We're just rotating in and out when it gets below that level. What does that mean? Okay, well, this is the risk-focused strategy. I did the math here, quick math. Started from 487, obviously. till this range. So we play the same range that we did as buy and hold. What does it equal? It equals 708%. Is that better than a buy and hold strategy? Now you're probably thinking, well, that doesn't include dividends. And you're right, it doesn't, okay? So the dividend payout structure might actually have been better, but I have more to add on to this. But like I also said, or what I haven't said yet is you would have held dividends still and reinvested here all the way till basically, wherever we got out, right here. So many years where you still are collecting dividends, and you'd have short periods of times where you're not collecting and reinvesting dividends. So keep that in mind too as well, for the haters in the comment section that are bound to come. So $5,000 would have turned into $40,425. That is a 10% lift than the buy and hold strategy, from $36,750, like I said, to $40,425. So 10% more money on the risk focused strategy. Now you might be thinking, yeah, but I don't want to have to deal with that, and 10% doesn't sound like that much. Yeah, it doesn't, but actually it actually really is. It is a big difference, especially when we start adding in other factors. What are the other factors that we can consider? Now, this is the most simplest, basic, just focusing on, hey, we're going to use the chandelier exits. If the monthly time frame closes below it, we're going to exit out and basically go to a risk off type investment or just cash. And then we're going to get back in when it closes above. All right. And as you can see, it's that simple. Okay. And that would have presented you 10% more money over the course of these 20 years, 25 years. Okay. Now, what if you add in more elements to this? For example, what if you were just, like I said, you were investing all along up this way, boom, 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 just like you would with the other portfolio, okay? And you would add more to this $5,000 balance. You were just increasing the amount, you were dollar cost averaging, but then when it closed below it, you continue to dollar cost average, but you take your main balance out of the equation. And then you put your dollar cost averaging, and then you put your main account balance back into play when it crosses back above, and you continue to dollar cost average. That would add, I don't have the numbers because I didn't feel like doing that math, but that would add a significant higher balance, obviously, to this overall portfolio. What's another element that you can use? Well, there's various other ways you can see when the market is overextended and underperforming, or when it might be overextended, I should say, to the downside. So for example, when the market was coming down to these levels, there's a high probability that instead of just dollar cost averaging all the way down, you can put in some more money on when you understand when they're overextensions on a more closer time frame, or if you're good at finding market bottoms, which with various indicators that I go over and we see and from a technical perspective, when you understand the basics of technical analysis, you can see when these bottoms are kind of forming. Now that's a more intermediate type strategy. But if you were able to find those and start investing more money at those levels, and then you put your full balance when it crosses above, notice how when you just pay a little bit more attention to your investments and you focus on the downside potential, when you focus on risk, you can get more money, just a lot, and you got to stick to that. You can make a lot more money, but the downside to that is when you see the market go running rampant like this, you can't join the mania and the hysteria of the other crowd because everyone wants to focus on making these massive freaking gains. I mean, when we take a look at Bitcoin now, do you notice the higher the market goes or a higher an asset goes, that's when more people start talking about it? Okay. And then all of a sudden, what's that one book? I forget the name of the book, but he was like, or who quoted it, but when your shoe shiner starts talking about individual investments, or your taxi cab driver, that's when we're coming to a market top. Well, I don't know how high the bubble can get. As of right now, technically with this basic easy strategy following a chandelier exit, can't get much easier than that. You'd still be technically in this right now until it actually got below the chandelier exit. So that is the very basic investment strategy. And it's not to say that, hey, everyone should use this strategy. I don't use this strategy. I don't. Should be totally clear. But I want to get the point across as how powerful it is to focus on risk, downside risk. I'm going to drill it in again. You can be the best trader in the world. Okay? You can get 9 out of 10 trades correctly. All right? 9 out of 10 trades is pretty amazing. But if you don't know how to manage risk, that one losing trade can not only rip apart your portfolio, it could just put you out of the game completely. Gosh, I don't know how many times I have to say it, but there's a couple things that you probably shouldn't be saying or doing, or if you're saying or thinking these things, you shouldn't be invested. No, you shouldn't be. Let me see. There's a couple of things that if you are saying or if you are thinking, you probably should step away from the markets, until you get your head on straight. If you think that you can time the markets or put a date on things and predict, that's not what technical analysis is. Technical analysis does not predict market movements. It never has, and it never will. Technical analysis gives us a good sense to be able to put educated risk on the table, right? It makes us be able to take more, educated risk. That's all it is. We can see real live data, fact, okay? This chart right here, this is real price action, okay? This is the market moving, ebbing and flowing to news, to economic data, to hysteria, to euphoria, to collapses, to everything. This is hard data. This is what the market did. All right. So what can we do with this data? Well, we can look at historic levels and we could plan trades around those historic levels. There's a reason why a lot of trades don't work out, but there's a reason why traders can become and investors can become so successful when they understand how to read and interpret charts. That's all I got for you on today's Daily Stock Market Brief, everybody.